Okay, I gave an assignment in one of my master's degree finance classes, and the students had to calculate beta and find the risk-free rate to do CAPM and do all that good stuff on a specific stock or specific company. And that's actually not that easy to do if you've never done it before. So I'm going to go kind of fast because some of the stuff I've done in another video called calculating beta. So I'm going to go kind of quick. So if you don't understand what I'm doing, just pause the video and go back and look again. Or you can go look up my video on calculating beta, because the beta stuff I'm going to do very quickly because I've done it in another video. So you go to my YouTube channel, Finance YouTube channel. I'll put a link to that video in the description also. So anyway, let me go real fast. So first we'll calculate beta, and I'm just going to, like I say, I've done it before in another video, but we'll just do it real quick. So I'm going to go to finance.yahoo.com. And when you want to do beta, the first thing you want to do is a market. So most people, you can use NASDAQ as a market, you can use, other things as a market, but most people use the S&P 500 as a market, so we'll go ahead and use that. And we want to get historical data for the S&P 500. Now, I could go over different frequencies. I can go weekly, monthly. I can go over different periods. So there's really no wrong way to do this. You could go weekly for 5 years, daily for 5. I'm just going to go ahead daily for 5 years. So I'm going to go 5 years from June 18th, 2015 to June 18th, 2020. Historical prices daily. I'm going to go apply. And I'm going to go ahead and download that. Once I download that, I'll open it up. And most likely, when you open it up, you're going to get something like this. It's going to open up in Excel. And we don't want these 4 columns, so I'm just going to go ahead and delete them. And we don't want the volume, and I'll delete that. And we'll call this the market. Well, let's just call it S&P 500. Okay? And so now we have the market. And now let's go ahead and go back to finance.yahoo.com. And I'm going to pick, let's say, Tesla. Now, you got to be careful because we want to find something that goes back 5 years. Does Tesla go back 5 years? It should, right? It's a fairly new company. But let's just make sure we can get 5 years. Historical prices daily, apply. And we'll download that. And open that one. Again, I'm going to keep the dates so I just see they line up. Again, I'm going to delete these columns. Just keep the adjusted close, delete this. And I'm going to call this TSLA for Tesla. And let me just highlight these and copy them and put them over into my other spreadsheet. Oops. Try that again. To get to the other spreadsheet, I'm just going to go Control Tab. I'm going to skip a column and put it right here. And I'd like to do the dates. I just like to make sure my dates line up. Go to the bottom and then go. Okay, so we can see. So I want to do the continuous return from this day to this day. So I'm going to go equals natural log of this divided by this. Now you could do percent return and it'll be fairly close. I'm going to go ahead and change that to percent. Take it out a couple places. So this is a daily return. I'm going to copy that down. And I'm going to take it and I'm going to copy it over here. And paste. Since my data is in daily, these are daily returns. So we can call this return on the market, and we'll call this return on Tesla. All right, and I'm going to go ahead and calculate beta. Now you calculate beta with returns, not with the prices. You got to calculate the returns. So beta is equal to the covariance of a population. And we're going to pick this array. And then comma. And remember, you just want to pick the numbers. And we'll pick this array. Okay, and then we want to divide it by the variance of a population of the market. Okay, so again, I'm going to pick this array. Oh, I forgot to put a parentheses, but it figured it out for me. So that's the beta. So this is the beta for Tesla. Right, it's a stock specific or security specific beta. Now I could check it another way. I could highlight this and go shift and down and come up and control, highlight this, shift and down. So you hit control to get two non-contiguous sets of data. And I can go to insert and do a scatter plot. We don't need the title here. And I can insert a trend line, so I can click on one of these dots and right click, go add trend line, and we can see that the slope of this trend line is the same as this beta. So really beta is also equal to the slope. I could use a slope equation. The known y's are right here, for Tesla, and then the known x's are market. And it's the same answer, okay? I'm going to put the formula in here so you can see it. Now I'm not going to show you how to test your regression and all that. That's something for statistics. The R squared here is fairly low, so that's telling me it's not a very good model. But I'm not going to do the regression or anything like that. But let's just go ahead and we'll use this beta. We'll run with it. And you know, you could go. Maybe I should. You go here and go in here and go into data analysis and run a regression and test the slope, and you can do all sorts of stuff like that. But that's for a statistics class. I'm not going to do that in here. We're just going to calculate beta. But you can see here, this model, you can, by looking at this visually, this R squared is very low, and if R squared was really good, all these dots would line up along this line, because this line is the best line to fit this data. And you can see this data is all over the place. So that's why this beta is probably not a very good beta. You know, mathematically you can calculate beta on anything, but it's just not, with that low of an R squared, it's not very good. All right, so now we have beta, and we also want to do the expected return on the market. And the expected return on the market, normally we're going to calculate it as equals the average of all of these. Okay. Now this is daily, and the reason it's daily because it's a daily average. And if we're going to use this on a CAPM, we need to convert that to a yearly average. This is where a lot of times students mess up, because they try to use this and then I'll show you why you mess up. It's a little bit confusing. So to do that, I'm going to use, well, let me go ahead and give you the equation here. So I'll just go ahead and put it right here. So just let me move the graph, and then we'll move this up here. Okay, so let me zoom in a little bit. So if you have daily average, you got to use this equation right here to make it into a yearly return. So it's going to be equal to parentheses 1 plus the daily average, the daily return, and then you have to take it to the 365 days in a year, right? And then subtract 1. And then let's go ahead and format that as percent. So I'm going to go home, percent, take it out a couple places. Okay, so that's the number we would want to use. So this is a number we're going to use in CAPM, and this is we're going to use in CAPM. Okay, and you could also do the expected return on Tesla, right? But we're going to calculate that a different way. But let's just do it anyway. We'll do it from here. Okay, and we can also copy this formula to get a expected yearly return. But we're not going to use that in the CAPM. I just wanted to show you that. Let's call this Tesla. Okay, so the next thing we need to do the CAPM, we need to figure out the okay, let me show you what the CAPM looks like here. So here's a CAPM. Okay, it's short for Capital Asset Pricing Model. And so we want to calculate the return on a typical stock. So this is not what we want, right? We're not going to use this. We want to calculate the return we expect, right? And we're going to use this part. So I need the risk-free rate. I have the return on the market right here. I have beta right here. So I need the risk-free rate, and I can calculate it. So the way we get the risk-free rate, I can go out to the internet, and I'm going to go to finance. No, I'm not going to go to finance. I'll go to, let's go historical 90-day T-bill yields, or rates. Yields or rates are the same thing. We'll go yields. And we're going to go, we're at treasury.gov. We're going right to the horse's mouth, right? The U.S. Treasury. And you can see we have it right here. Daily treasury rates. And that's good because these are daily, right? So we want that to be daily. And 13 weeks is 90 days, right? So we're going to get this coupon equivalent. But the problem is we're going to go from 6/19/2015 all the way to right now. So I don't want the current month. I'm going to go ahead and go all, and then go. It's going to take it a while because I'm going to go get them all. And so I'm going to scroll down to, remember we want to start at 6, and we want to use the same period we use here. We want to start at around June 19th, 2015. So it starts at, since I went all, I got to go down a few years. I'm going to go down. So there's 6/19/2015. So I'm going to highlight across here. And this is kind of the slow way. There's other ways to do that. I'm just showing you a quick and dirty way to do it. So I'm going to highlight all this. And while I'm on it, I'm going to right click and go copy. And let's go back to Excel. And I'm just going to go ahead and paste it right here. The only thing is I don't see the header. So I'm going to go back to here. Go up to the top. Let me get these headers right here. We want this one, right? Let's get them all. And okay, let me try it again. Let me insert some space here so I don't. Okay, so now we know what the columns are, and we want, remember, we just want the 13 week. We want this one, right? I want to make sure. You know what? Let's just do this a different way because it looks like it's messed up. I'm going to go Control Z, Control Z. Let's go just look at it. What column is the 13 weeks at? We want this one right here, so it's going to be 1, 2, 3, 4, 5, 6. The 7th column is the one we want. So I'm going to keep the date. I'm going to get rid of, this is 1, 2, 3, 4, 5, 6, 7. So we want that column. So I'm going to keep the date. I'll get rid of these. And I'll get rid of these. So we just want this. Okay? And really, we want to calculate R sub F, and we just want the average. So I'm going to go equals average from 6/19/2015 all the way down to 16/19/2020. And There we go. We have the average. Now, this is already in percent. And it's already yearly. So that's where students kind of, so it doesn't say percent. So let's go back over to here and we'll put in R sub F. And R sub F is equal to this over here. And I'm going to divide it by 100 to make it into percent for Excel. And then I'm going to hit here and go percent. Take it out a couple places. Okay. So now we have R sub F. Does that make sense? We'll put it in here, equals formula text. Let me put all these formulas in here. Okay. So now we can do our CAPM. So we want to calculate the expected return of Tesla. Okay, and we're going to use our CAPM. It's going to be equal to the risk-free rate plus beta of Tesla times parentheses the expected return on the market minus the risk-free rate. And that's kind of crazy to have that out so many places. Let's make it one place. And that's the CAPM. That's our answer. So we went through all that to calculate that right there. All right? So that is not the same as this, is it? So don't use this. You want to use this. Okay? So hopefully that makes sense. There's a few things you got to worry about. Now this is still a CSV file. So here you might want to say beta and CAPM. And here you might want to say risk-free rate. So remember, this is already in percent, so you have to divide it by 100 right here. You have to divide it by 100 to make it percent, and then you can format it as percent. And then also, this is daily, so you got to make it yearly, because this is already yearly. You have to make all the units the same when you plug them into the CAPM. Okay, so I think that's all I have to say about that. I know I went kind of quick. Like I say, I've done beta before. But I guess it's a nice review. I've never done with CAPM in conjunction with CAPM. But it can be really tricky, figuring out, well, what does this mean? Because when you go download it from the Treasury, it doesn't really say what it is. 0.01, that looks like it's percent, decimal form of percent, but that's actually a real percent. Okay, you go down further, you can see numbers that are more realistic, right? 1.77%. And also you have to know that that's yearly. All right. So you want to remember, when looking up the T-bill room, usually posted in yearly and percent. Okay. So what is my market risk premium? My market risk premium, remember we have the equation right here. All it is equal to the expected return on the market. And remember that's yearly divided by the yearly risk-free rate. Or subtract the risk-free. So my market risk premium, let me go ahead and, so that's what my market risk premium is. Okay. All right, so I'm going to have my picture come up here. Oh, by the way, I was going to say this is a CVS file, so you probably want to save it as an Excel file. Excel workbook. We'll say beta and CAPM Tesla. And let me save that in Dropbox. Classes, summer. Save. Okay, so I'll go ahead and I'll put a link where you can upload this file. You can take a look at it also. And my picture will come up here. If you like this video, subscribe. My picture will be right here. And put any comments you like. So hopefully that helped. So if you're doing my master's class and you followed another beta video, all you really need is this right here. I just did this for you, right? So all you need is that's the risk-free rate you should be using. And you all remember, whenever you calculate you got to make sure you convert your daily average to a yearly average using this formula. So if you're doing my master's degree class for that group project, that's what you got to do. All right. Thank you. Bye-bye.